You are welcome to my beginners class on final accounts of sole traders. If you are coming across my lecture for the first time, please don't forget to click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I pray that God will bless you. Now, what do we mean by sole traders? Sole traders or sole trader or sole proprietorship. Sole proprietorship. This is a one-man business. A sole trader or sole proprietorship is a one-man business. Any business that is owned and managed by one person, such business is said to be sole trader or sole proprietorship. A business that is owned and managed by one person is said to be the sole trader or sole proprietorship. Now, what are the terminologies used in final accounts of the sole trader? Definition of terms. Definition of terms. Number 1 term I'm going to examine is opening stock. Opening stocks or opening inventories. Opening inventories. Opening stocks are stocks in hands at the beginning of the trading period. Stocks in hands. Stocks in hands at the beginning of the trading periods or period is said to be the opening stocks. Now, number 2, we have purchases. Purchases are goods bought for resales. Goods bought for resales. That is purchases. What the entity, what the organization is dealing in. What they are dealing in, their primary business. So what they buy with the intention of reselling them. That is purchases. Now, number 2, we have carriage invoice. Carriage invoice. This can also be called carriage on purchase. Carriage on purchase. Carriage invoice or carriage on purchase. These are the costs or expenses incurred in bringing the goods from the place of purchase to the warehouse of the organization. The cost incurred in bringing the goods from the place of purchase to the warehouse of the organization. Now, for instance, if your business location is in Akure, location of the business, if it is in Akure, and the owner travel to Lagos to buy some goods, and that goods bought from Lagos will be transported from Lagos to Akure, the cost incurred in transporting the goods from Lagos to Akure is carriage inwards because the location is Akure. Cost of transporting it into the warehouse of the organization, that is inwards. In transporting them in, that is into the store of the organization. Therefore, since these goods, this cost were incurred in transporting the goods to the store, that means it is the goods, since it was incurred in transporting the goods purchased to the store, they should therefore form part of the purchase price. Maybe you go to Lagos, you buy the goods worth, let's say if purchases is 100,000, and you incur 10,000 naira in transporting them to the store, which is carriage inwards. Therefore, you are going to add the 10,000 to the purchase price to get 110,000. That means the actual cost of the goods bought is 110,000. Therefore, anytime you see the carriage inwards, it should always be added to the purchase price, to the cost price of the item. Always add the carriage inward to the cost price of the item. Carriage inwards will always form part of the purchase price. That is why we normally add carriage inwards. Number 4 term I'm going to examine is return outwards. Another word for return outwards is return on purchase. Return or purchase return. Purchase return. This is the cost of goods returned to the suppliers. The goods have been bought by the entity from the suppliers. Suppliers are the seller, the person that sells the goods to the organization. So these goods have been taken down to Akure, which is the location of the business, and they discovered that some of them are of wrong color. They now return them back to the suppliers. That means it is from part of the purchase that are later returned. So that is why we call them return on purchase or return outwards. The cost of goods returned back to the suppliers. Cost of goods returned to the suppliers. Since it is part of the purchase that were later returned, therefore this will always be subtracted from the purchases. Therefore, we have ascertained the cost of the goods bought to be 110,000. If 5,000 worth of goods were returns outwards, if it is 5,000 naira. Therefore, you are going to subtract the 5,000 from 110,000. That means the cost of goods purchased now will be 110,000 minus 5,000. That means you'll be having 105,000 naira. Therefore, purchase returns will only be subtracted from goods purchased. Take note of that. Number 5, carriage outwards. Carriage outwards. Another word for carriage outwards is carriage on sales. You may call it carriage outwards or carriage on sales. That means expenses incurred in transporting the goods from the warehouse of the organization to the final consumers. Cost of transporting the goods from the warehouse of the organization to the final consumer is said to be the carriage outwards. Another word for carriage outwards is carriage on sales. It is expenses incurred. It is a selling expenses. Carriage outwards, since it is a selling expenses, that is, this carriage outwards was incurred in selling the goods. So when you want to transfer the goods from your place, that is from your warehouse, you want to transfer it to the final consumers, that means you incur it in selling the product. It's a selling expenses. Being a selling expenses, it should be treated as a selling expenses in the profit or loss. We don't use to deduct it from sales, unlike the carriage was that will be added to purchases. We don't use to add this one to sales. Neither should it be deducted from sales. We only treat it as an expense, selling expenses in the profit or loss accounts. Then we have number 6, return inwards. Return inwards. Return inwards or return on sales. Return on sales, or you can say sales return. These are goods returned by the customers. Goods returned by the customers. That means after selling the goods to customers, you've assumed you've sold the goods, you've sold the goods. Since you have assumed that these goods have been sold and they were later returned by the customer to you, therefore, that means if you have sold goods, if your sales, if it were 200,000 naira, if you have sold goods worth 200,000 and the customer returned goods worth, let's say 15,000, sales returns or return inwards. Sales return, I have told you that sales return can also be called return inwards. If you have sales return of 15,000, that means customer return goods worth of 15,000 to you. It is part of this 15,000 return have been recorded by you as sales before. That means it has formed part of this 200,000. Since it has formed part of the 200,000 naira, since it were later returned, we are going to subtract it from 200,000. So that is why we normally less return inwards or sales return from the sales. So that means the value of goods sold now will be 185,000 naira if you subtract sales return from it. Now, number 7. I want to examine the gross profit. Gross profit. This is the profit before the deduction of expenses. The profit before the deduction of the operating expenses. That is gross profit. Therefore, gross profit is the excess of sales over cost of goods sold. Cost of goods sold. Excess of sales, that means gross profit equal to gross profit. That is sales minus cost of goods sold. Sales minus cost of goods sold. That will give you the gross profit. Or you can have net sales. Another word for net sales is sales less sales returns. You can use this 185,000 as your net sales. If you don't want to call it net sales, you can call it turnover. You might have your turnover to be 185,000. Another word for turnover is sales. That means if this sales return is not given in the question, your turnover is 200,000. But if return invoice is given, then your turnover is 185,000 in this case. So your turnover is your net sales. So your net sales is sales less sales returns. So gross profit is net sales minus cost of goods sold. Or you can simply say gross profit equal to sales less cost of goods sold. That is gross profit. Therefore, what is cost of goods sold? Cost of goods. Before I examine cost of goods sold, let me examine closing stocks. Closing stocks or closing inventory. Closing stocks or closing inventories. Closing stocks or closing inventory. Closing stocks is the stocks in hands at the end of the trading period. Stocks in hands or in hand at the end of the trading period. Stocks in hand at the end of the trading period, the one that remain unsold. You have bought some stocks during the period and you have some in hands at the beginning of the period. Then after sales have been made during the year, then you are still left with some stocks that have not been sold. Those ones you are left with that have not been sold during the trading period, they are called closing stocks or closing inventories. Therefore, number 9, we have cost of goods sold. Cost of goods sold is the cost of goods that remain and that have been sold during the trading periods. Cost of goods that have been sold during the trading period. Therefore, cost of goods sold is the cost of goods available for sales less closing inventory. To get cost of goods sold, you have cost of goods available for sales. Cost of goods available for sales less closing stocks. So if you less closing stocks from cost of goods available for sales, then you get cost of goods sold. That is why I said cost of goods sold is cost of goods available for sales less closing stocks. That is excess of cost of goods available for sales over closing inventory. I mean, cost of goods available for sales less closing inventory. That will give you cost of goods sold. Number 10, cost of goods available for sales. This is the cost of goods in hand that are ready or that are available for sales during the trading period. Cost of goods in hands readily available for sales during the trading period. That is cost of goods available for sales. Cost of goods in hands readily available for sales. Cost of goods in hands that are ready for sales during the trading period. That is cost of goods available for sales. To get cost of goods available for sales, you start with opening stocks, Then you add purchases. Remember, I've told you earlier that carriage inwards should form part of the purchase price if given in the question. Therefore, you add carriage inwards. If you have any in the question, you add your carriage inwards. Then you get this. And if you have return outwards, I've told you that return outwards can also be called return on purchase. You are going to subtract return outwards from purchases based on my earlier explanation. So we less return outwards. When you less return outwards, then you get this. This plus the opening stock will give you cost of goods available for sales. Cost of goods available for sales. But where you don't have carriage inwards and return outwards, that means cost of goods available for sale will be opening stocks plus purchases. 7. Trading account. Trading account is the account prepared to ascertain the gross profit or gross loss for the trading period. The account prepared to ascertain the gross profit or gross loss for the trading period. That means the purpose of preparing trading accounts is to ascertain the gross profit or gross loss for the trading period. Number 12. Profit and loss account. Profit and loss account. This is the account prepared to ascertain the net profit, or net loss for the trading period. The account prepared to ascertain the net profit or net loss of the trading period. That is profit and loss account. Number 13. What is net profit? Net profit. Net profit is the profit after the deductions of all operating expenses. After deducting all operating expenses, you arrive at the net profit. The profit after the deductions of all operating expenses. Therefore, net profit equal to gross profit minus operating expenses. Gross profit minus operating expenses. That will give you the net profit. Number 13. We have expenses. Expenses are costs incurred in running the business. The costs incurred in running the business are said to be the business expenses. Examples of expenses of the business include the salaries and wages, rent and rate, lighting and cooling, or lighting and heating, whichever one you call it, office expenses, insurance, postages, telephone expenses, etc. The expenses incurred, the cost incurred in running the business are said to be the business expenses. Let me see. Samuel Enterprises. Trading, profit, and loss accounts for the year ended 31st December 22X. So you have to state the year. So we have the debit side and the credit side. At the credit side, you have sales or turnover. sales. You put the amount there. From sales to less, return inwards. Return inwards. I've told you that another word for return inwards is sales return. So when you less that, you get the net sales. Net sales, or you may call it turnover. At the left hand side, the debit side, you start with opening stocks. Opening stocks. I've told you opening stocks are stocks in hands at the beginning of the period. This stocks is what we already have at the beginning of the year. But this one is not enough for you to sell. So what will you do? You buy more. Then you have purchases. You add purchases. Purchases. In my previous or earlier explanation, I've told you that when you have carriage inwards or carriage on purchases, that have to be added to purchases. So you add carriage inwards or carriage on purchase. So, and after the goods have been bought, you discover that some of them are bad, so you return them. So you have return outwards. Less return outwards. So when you subtract your return outwards from purchases, you arrive at this. If you add this to your opening stocks, you arrive at cost of goods available for sales. Cost of goods available for sales. I've told you that if you less closing stocks from cost of goods available for sales, you arrive at cost of goods sold. So you less closing stocks. If you subtract your closing stocks, you arrive at cost of goods sold. This is cost of goods sold. The cost of goods sold you've arrived at, you subtract it from your sales here. Sales minus cost of goods sold, I've told you it will give you gross profit. That is the difference between the two sides. This minus this will give you this. So the total is this. The total, what you have here will be brought down. But where this side is more than this side, if cost of goods sold is more than your sales, you arrive at gross loss here. So gross loss carried down. That is your cost of goods sold. If it is more than sales here, you arrive at gross loss. The gross profit you have got here, you brought it down here. You have gross profit brought down. And if it is gross loss you have here, you are going to bring it down here. Gross loss brought down. Then if you have any other income, like discount received, any other income, discount received, you add them to your gross profit. Rental income, interest income or interest received, commission received or commission income. Any other income you have, you add it to it. Let me say other income. Other income. Then, if you add all this income, you arrive at the total income at the credit side. Total income. Then at the debit side here, you have expenses. Expenses. And expenses include administrative expenses, which include salaries and wages, rent and rates, insurance, lighting and heating or lighting and cooling. Then you also have general expenses, if any, general expenses. Or you might also have office expenses. Office expenses.
Then you may also have carriage. Let me say you have sundry expenses. Sundry expenses. Then you may have postages. Postages. You may have telephone expenses. Telephone. Telephone. Then telephone, we've made mention of telephone. Packaging expenses, if any. Packaging expenses or packing expenses. Then you may have carriage outwards. Carriage outwards. Then you may have bad debts. Bad debts written off. Bad debts written off. Then you might have increase in provision for bad debts. But let me leave that to adjustments. Then you can have depreciation. Let me say motor running expenses. Running expenses. You may have transport expenses. You may have carriage. Okay, I've written carried outwards. Then depreciation. Any other expenses, let me say others. Any other expenses? When you add all the expenses, you know the credit side you have your income. You now subtract the expenses from the income. If you subtract it from the income and the credit side, you arrive at the net profit. It will be net profit where the income and the credit side is more than the total of all the expenses at the debit side. You have the total. But where the expenses at the debit side is greater than all the income at the credit side, then you have net loss. Net loss, carry it down. Then you close your accounts. Close the accounts. Balance sheet. Balance sheet. Balance sheet is a statement that shows the financial position of the business. As at a particular date. A statement that shows the financial position of the business as at a particular date. That is balance sheet. Balance sheet shows the assets, liabilities, and equity of the owners. Equity of the owners. It shows what? It contains assets, liabilities, and equity or capital. It shows the assets, liabilities, and capital of the owners. Therefore, we want to look at each of these elements of balance sheet. I've told you that balance sheet is a statement that shows the assets, liabilities, and capital of the owners. What are business assets? Assets are the resources owned by the business. The resources or property owned by the business. Any property of the business are said to be the business asset. For our purpose, we will categorize our assets into two. Number one, we have fixed assets and current assets. Anything the business have at all is the business asset. For instance, the business may be having a motor car. The motor car the business have is an asset to that business. If a business is having a land, the land of the business is an asset of that business. If the business is having furnitures, that furniture is an asset of the business. In fact, this calculator is my asset, only that the value of it is immaterial. Based on materiality concept, we can treat the value as an expense. So, but I just want you to understand what an asset means. If a business is having sets of shares, those shares are the business assets. If a business is having motorcycle, the motorcycle of that business is an asset to the business. Anything the business have at all is an asset. The money the business have in hand, cash in hands, is an asset to that business. If the business is having cash at bank, the money the business is having at the bank is an asset to that business. So I believe with my explanation and analysis, you will understand what an asset means. So for our purpose, we are going to categorize the asset into two. Some of those assets, those things are mentioned. Some of them will last long. They can stand the test of time. Those ones that can last longer, we call them fixed assets. Assets that are permanent in nature. Fixed assets are permanent assets. Those assets that can stand the test of time. Those assets that you cannot use them within just, let's say, few months or a year, that can last more than 1 year. Those assets that can last more than 1 year, we call them fixed assets. Assets that can last more than 1 year, they are fixed assets. Example are motor vehicles. Motor vehicles can last for like 5-6 years or more. So it's a fixed asset. Land and building, land can last more than 100 years. So land is a fixed asset. So fixed assets include fixed assets. Examples of fixed assets are land and building. Building may last for 50 years or more. So plant and machinery, these are fixed assets. Motor vehicles or motor car, motor vehicles. Then furnitures and fittings. I've told you that fixed assets, I said they are assets that can stand the test of time, assets that are permanent in nature, assets that can last longer. Then the second category are current. As the name implies, current. When we say current year, an asset that doesn't last more than 1 year. So current assets are assets that cannot last more than 1 year. Examples of current assets include stocks in trade. If a business is having stocks, the business is expected to sell everything within a year. So stocks in trade. Debtors. If people are owing their business, those people are expected to pay up within a year. Short-time debtors. Then cash in hands. If you are keeping money in hands, then you are expected to use that money within a year. Even though you use it, then you will still get another one. So cash in hand doesn't last for so long. Cash at bank. So it's a current asset. Prepaid expenses is also a current asset. These are the examples of current assets. Then, on the other hand, the second element we are going to examine, we've examined current assets. The next one is liabilities. What are liabilities? Liabilities are debts owed by the business. Debts owed by the business. Debt owed. Debt owed by the business. That is liability. Debt owed by the business are business liabilities. So some of these debts the business is expected to pay them within a year. Some will take long period before they can be repaid. Those debts that the business are expected to pay back within a year, we call them current liabilities. Those debts that are expected to take more than a year before the business can pay them back, we call them long-term liabilities. So liabilities, I've told you, they are debts owed by the business. For our purpose, we want to categorize the liabilities into two: the long-term liabilities and the current liabilities. The debts the business the debt which the business is expected to repay within a year, I've told you that those ones are current liability. But those ones that cannot be repaid within a year, that is long-term liability. Therefore, long-term liability are debts that cannot be repaid within a year. Example of long-term liability is bank loans. Bank loans is an example, common example. Debenture is a debt instrument, but bank loans, so they are long-term liabilities. But those debts that are expected to be repaid within a year, that one is current liabilities. Examples of current liabilities is creditors, trade creditors, bank overdraft, then accrued expenses, bills payables. Format of balance sheet. There are two sides to balance sheet. We have the left hand side, which will contain capital and liabilities. The right hand side, which will contain the assets. So these are the items you used to have in balance sheet. Now let me give you the comprehensive format. So you can have Samuel Enterprises balance sheet as at 31st December 2022X. So you have net book value. We have the accumulated depreciation, and we also have cost. At the right hand side, you have fixed assets. Example of fixed assets I've given include land and building. If you have any land and building, you have it here. The cost of it, the accumulated depreciation. By the time we are taking a work example, then I will explain this further. The accumulated depreciation, if you subtract it from cost, you arrive at the net book value. Plant and machinery. The cost of the plant and machinery, the accumulated depreciation on it, when you subtract it, you arrive at the net book value. Motor vehicles, the cost of the motor vehicles, the accumulated depreciation, then the net book value. Then furniture and fittings, the cost of it, the accumulated depreciation, and the net book value. Then when you sum up this, the total. If the business is making any investment, any long-term investment, you may have the investment here. Then, if the business is having intangible assets, intangible assets. But let me leave this because it is sole trade business. So when we get to company final accounts, so we will consider that. So this is the total. Then we have current assets. Current assets. At the left hand side, you have capital. You add net profit. You add net profit. You add net profit to your capital. Then you less drawings, if any. Less drawings. So if you less your drawings, you arrive at the capital employed. Then this is capital employed. Then you have long-term liabilities. Long-term liabilities, which include bank loans. Then you also have current liabilities. And the current liabilities include your trade creditors, your bills payables, then bank overdraft. Then you may also have accrued expenses. Then the current assets include closing stocks, your stocks in trade, your closing stocks. Then your debtors, your trade debtors. Then your bills receivables. Then your cash at bank and cash in hands, prepaid expenses. Then when you add the total of all the assets, it must agree with the total of your equity, that is your capital and liabilities. The balance sheet will balance. Example, from the following trial balance of see what you are required to draw up a trading and profit and loss account for the year ended 30 June 2024 and a balance sheet as at that date. You have the trial balance as at 30 June 2024. The debit side and credit side amount in dollar. Sales 28,794. Purchases 21,428. Rent and rates 854. Lighting and heating expenses 422. Stock 1st July 2023 2,375. Where you are given stock in trial balance and another stock is given in additional information. The stock in the trial balance is the opening stock, while the one in additional information is the closing stock. But where no stock is given in the trial balance and you only have, where no stock is given in the additional information and you only have stock in the trial balance, that means the stock you will be given in the trial balance is the closing stock. And most of the time, the date will be attached. If you look at the year end, for the year ended 30th of June 2024, this is the year end of the business. But this stock is 1st of July 2023, so it relates to the beginning of the year. The accounting period will run from July 2023 to June 2024, which is 1 year, 12 months. So the stocks in the trial balance in 2023 is opening stocks. Salaries and wages 3,164. Insurance 105. Shop buildings 50,000. Shop fixtures 1,000. Debtors 3,166. Trade expenses 506. Creditors 1,206. Cash at bank 3,847. Drawings 2,400. Motor vans 5,500. Motor running expenses 1,133. Capital 65,900. The total of both the debit and credit side is 95,900. Then you have stocks as at 30th of June 2024 was 4,166. This is the closing stock. Now, you are required to draw up a trading profit and loss account. Trading and profit and loss account. Now, let's put the name of the business. See what is the name. So we have C Worth. C Worth. Trading and profit and loss account for the year ended. For the year ended 30th of June 2024. So you have two sides. The left hand side and the right hand side, credit side. At the left hand side, I've told you that at the right hand side, I've told you that we are going to have sales there. How much is our sales? Sales amounted to 28,794. And there is no returning was. If you go through the question, no returning was. I've told you that we used to subtract returning was from sales. Since there is no returning was, that means at the credit side, we only have sales 28,794. 28,794. At the left hand side, you start with opening stocks. Opening stocks. Go through your trial balance. How much is our opening stocks? You are given stocks at 1st of July 2023, 2,375. Opening stocks amounted to 2,375. I've told you that you are going to add purchases to this. So you add purchases. Go back to the question. How much is our purchase? You are given purchases of 21,428. But let's check if you have carried inwards. There is no carried inwards anywhere. They do have return outwards. There is no return outwards. That means we only have purchases of 21,428. If you have carried inwards, remember I've told you you are going to add it. Purchases amounted to 21,428. 2,375 plus 21,428. We have 23,803. This is cost of goods available for sales. From this we less closing stocks. Less closing stocks. The closing stocks. Stocks as at 30th of June 2024 was 4,166. 4,166. That is closing stock. If you subtract 4,166 from cost of goods available for sales, you have 19,637. That is cost of goods sold. Then you now subtract the cost of goods sold from sales. Our sales is 28,794. Then we have the gross profit of 9,157. That is our gross profit. Then the total is 28,794. 28,794. Then the gross profit we have obtained here, you bring it down. So we have gross profit brought down 9,157. Now, the next thing is expenses. We have the expenses at the debit side. Expenses at the debit side. Back to the question. Then we have rent and rates, 854. rent and rate 854. Then we have lighting and heating expenses 422. Then lighting and heating 422. Then we have stores at 1st of July, which is our opening stores, and that have been used earlier. Then we have salaries and wages of 3,164. Salaries and wages 3,164. Then we have insurance 105. Insurance 105. Shop buildings is a non-current asset. Shop features is also a non-current asset. Debtors is a current asset. Then we have trade expenses of 506. Trade expenses 506. Then we have creditors is a liability. Cash at bank is an asset, a current asset. Drawings should be deducted under equity in the statement of financial position. We have motor vehicles, that is a non-current asset. Motor running expenses 1,133. That is the only expenses we have. We are left with motor running expenses. Motor running expenses is 1,133. Now, you now sum up all the expenses. We have 854 plus 422 plus 3,164 plus 105 plus 506 plus 1133. Our expenses is totaled. All the expenses is totaled 6,184. You now subtract the total of all the expenses from our gross profit of 9,157. Then you arrive at the net profit. Net profit. It is a net profit because the gross profit is greater than the sum of all the expenses. Remember, the sum of all the expenses is 6,184. The expenses is less than gross profit. So, gross profit is greater than the total of the expenses. So, we have the difference of 2,973. That is our net profit. So, we now have 9,157. 9,157. So that is the trading profits and loss account. The next thing is the balance sheet. Balance sheet. The name of the owner of the business is C what? C what? Balance sheet. Balance sheet as at June 30, 2024. So I've told you that there are two sides to balance sheet, the left hand side and the right hand side. So balance sheet is not an account. As a result of that, it's not compulsory you put DR and CR. It's not necessary. So at the left hand side, you have capital. Capital. Now, we have capital of 65,900. 65,900. Capital 65,900. Then we now add net profit. Now, back to profit or loss. We have the net profit of 2,973. 2,973. When you sum it up, so you have 68,873. Now less drawings. Drawings. How much is our drawings? We have drawings of 2,400. 2,400. So we subtract that. Minus 2,400. So we have 66,473. Then at the right hand side, you have fixed assets. There is no depreciation in this question. So as a result of that, I may not necessarily write cost, accumulated depreciation, and net book value, since there is no depreciation in this question. Then our fixed assets include shop buildings, 50,000 naira. Shop building, 50,000. Shop building, 50,000. Then we also have shop features, 1,000. Shop features of 1,000. So if you go through the trial balance, we also have motor vans. Motor vans of 5,500. Motor van 5,500. So these are only non-current fixed assets we have in the question. So if you sum this up, if you add it together, you'll be having 56,500. 56,500. The next thing is current assets. Here we have current assets, and at the left hand side we have the current liabilities. This item, we don't have asset or liability. I want to rub off so that we can extend the solution to that place. So we have current assets. Then we also have current liabilities. Back to the question, salary is an expense. Okay, now let me pick the closing stock. We have the closing stock of 4,166. The amount is in dollars, so let me change this to dollar, not naira. 4,166. Our closing stocks, 4,166. Now, this is an expense, this is an expense. These have been used. Then we have debtors. Debtors is a current asset. We have 3,166. Debtors, 3,166. Then trade expense have been used. Creditors is a liability. 1,206. Creditors, 1,206. That is current liability. Then we have cash at bank, 3,847. Cash at bank, 3,847. Drawings have been used, multiple bands have been used, multiple running expenses have been used, capital have been used. So that is all the items. So we now sum up. Let's add it up. Now, the left hand side, 66,473 plus 1,206. We have 67,679. That is the total of the left hand side. Now the right hand side, we have 56,500 plus 4,166 plus 3,166 plus 3,847. So we have 67,679. 67,679. If you look at the total of both the left hand side and the right hand side, we have the same figure. That's to show that our balance sheet balance. So this is the end of the part 1 of final accounts of sole trader. My next presentation, I will examine adjustments to final accounts, where I will consider the treatment of provision for depreciation, the provision for bad and doubtful debts, the treatment of accruals, prepayments, and so on. Please, have you liked the video? If you have not done that, please don't forget to click the like button. Just thumbs up. Thanks for watching Ezika.